Hi, everyone. I'm Jeran Van Alphen, certified financial planner and founder of Centered Financial. Just wanted to share with you this new video series we're doing focused on financial planning called Ask Jeran. I'm going to share a question that we get regularly and just talk about our thoughts and what we recommend. So the first question is, why not keep all my money in cash? Right now, there's some really great things with the yields that we're seeing on cash. It's better than we've seen in years. So money markets and high yield savings accounts are giving yields close to 5%. Short-term CDs are above 5%. And the principal in these accounts is considered stable because you typically have FDIC insurance up to certain limits. So with all that, why would you not want to keep all of your money in cash and take advantage of these yields and of where they're at? So before I answer that, first of all, I just want to make sure you know this information is general education. It's not specific financial advice for any individual. If you do have questions about your specific situation, please reach out to us. We're always happy to chat and go a little bit more in depth. Okay, so first of all, define what you want your money to do for you. What I mean by that is we have to separate money into short-term objectives and long-term objectives. Short-term goals, emergency reserves, money that you're planning on withdrawing from your savings, in the near term. Large purchases like down payments on a home, vehicle purchases, car, RV, boat, things like that. Or if you're planning a trip, anything like that, it is good to keep cash on hand. You don't want to invest money and put that money at risk. However, for long-term goals, retirement, college savings, if it's more than 5 years out, if you have long-term periodic withdrawals coming out of your portfolio, or paying off a long-term debt, all of that money is in the future, and we need to make sure we take advantage of investing to grow your money for those objectives. Why? So let me explain what I mean by this. So if you look at this chart, this is from JP Morgan Asset Management. It shows the growth of $10,000 over a 30-year period from 1992 to 2022. I want to point out specifically the green and the purple T-bills is your cash equivalent. So that's going to be similar to what you'd get in a savings account. And what you can see by this is over that 30-year period, inflation has outpaced the savings. So you're seeing much better returns in stocks and even bonds. So again, if we're looking long term, if we're investing for retirement, if we're investing for college, we want to make sure that we're at least outpacing inflation and we're capturing higher returns in order to meet our objectives. But in the short term, we may be okay just keeping pace with inflation over the next few years in order to have our money be stable for those short-term needs that we have. Okay, the other thing that you need to take into account with returns is what your real return is with inflation. So what this shows is historically real returns on cash on 12-month CDs. So if we look at as of June of this year, average 12-month CD yield is 5.36%, but inflation is 3.09. So the real return that you're getting on that yield is a little over 2%. If we look at the historical average with taxes and inflation, real return is about a percent. So again, long term, we may not receive the returns that we need to reach our objectives if we're keeping our money in cash for too long. Okay, the other reason that we need to stay diversified and allocate our money to these two different buckets is just smart investing principles where you want to avoid buying high and selling low. The reason I talk about this is because if you've been invested over the last few years, and specifically if you've been in bonds through 2021 and 2022, it's been pretty frustrating. You've had 2 consecutive years of negative return. First time that's happened going back to 1974. The aggregate bond index now has a negative 3-year return. So if you've typically kept your money in bonds for the fixed income or the yield part of your portfolio, and now you want to move that to cash, the danger is you may not receive the returns going forward that you need to bounce back and make up those losses that you've had over the last few years. This chart just shows kind of a hypothetical. So if you've had an 8% return over a number of years, you're averaging 8%, and then you lose 8%, how much of a return do you need to get back to that 8% return? The answer is a 26.5% bounce in the next year in order to get back to your average of 8%. So just illustrates, the principle of staying invested, moving money to cash while giving good yields in the short-term period may not provide the opportunity that we need to get back to the returns that you need for your long-term plan. Okay, this chart just illustrates that as well. It shows that what happens in asset classes, so bonds and stocks, after interest rates peak. Right now, we have this high interest rate environment. At some point, that peaks and starts to come down. And you can see that in the first year, this dark blue, the returns are much higher, bouncing back and then gives us that positive average return over 5 years. But we want to make sure that we're invested in order to take advantage of that bounce. It goes back again to that principle of staying invested and not missing those best days of the market that contribute to our returns. So putting it all together, if we take all that information, what should we do? Keep the equivalent of 3 to 6 months of monthly expenses in cash. Don't put that at risk. Determine how much money you need for short-term objectives. Anything that you're going to spend money on within the next 12 to 24 months, that money's coming out of your savings. We don't want to put that money at risk. That should be kept safe. With anything longer, if we're looking out beyond that 2 to 3 year period, then we want to stay invested in a diversified portfolio and capture those returns that the market gives us to outpace inflation. Okay, that's everything for today. Let me know if you have any questions. I'm happy to go more in depth individually. Take care.